Many business owners will need to borrow in order to achieve their business goals. So how exactly do lenders decide whether to provide you credit? Hi, I'm Kara for Ulnoeg Development Group, and in this Business Minute, we're going to take a look at what lenders look for and why. So how exactly do lenders decide whether to provide you credit? When lenders review a credit application, they're assessing risk. They're also assessing the ability and the likelihood of loan repayment. These are essential parts of the assessment. Lenders will consider your credit history, your team, the financial health of your business, and your collateral. When it comes to determining your creditworthiness, there are 6 key rules to keep in mind. Rule number 1, establish a credit report. You often need credit history to get new or additional credit, and your credit report acts as your financial reference. Rule number 2, always pay as agreed. Late payments, which are also called delinquencies, will negatively affect your ability to get credit. That's because late payments in the past indicate likelihood to lenders that you'll make late payments again, or that you'll be unable to pay your debts in the future. Rule number 3, keep your balances low. Loans are essential, but your revolving credit says how you manage your debt. When you keep your balance low compared to your credit limits, this demonstrates a resistance to temptation to charge more than you can pay. Rule number 4, be cautious when applying for credit. Avoid applying to multiple loans or filling out multiple borrowing applications within a short period of time. Too many inquiries on your credit report within a short time can be a sign of financial distress. Rule number 5, time is key. It takes time to build a credit history and for those changes to reflect on your credit report. Rule number 6, have a plan. Be accountable for your decisions and know how you're going to repay your debts. So what do lenders look for with respect to your team? Lenders want to understand your business operations. They'll assess staff and management regarding their level of experience and their qualifications to determine your venture's viability. They'll look at your resumes and the qualifications required to operate the proposed project or venture. What do lenders look for with respect to financial health for your business? Lenders will want to review the historical financial statements to evaluate your operating performance and your financial strength. They'll typically require 3 years of financial statements, as well as most recent interim statements. If these aren't available, they'll require financial projections for future profits to evaluate your capacity to repay the loan. Your income statement is something that lenders will look at to evaluate your revenue sources and trends, as well as your expenses, to see if your business makes or loses money each year. Lenders will want to see your balance sheet. They'll use this to evaluate the total assets, which is what you have access to for cash and equipment or property. They will compare this to your liabilities, which is where you currently owe to suppliers or other lenders. Lenders will also look at your cash flow statement. They'll assess whether your operating cash flow is sufficient to cover your operating expenses or to manage a potential downturn in your industry or market. They'll also evaluate if you have to borrow funds to cover any operating expenses for future expenses. With respect to financial projections, lenders will ask you to provide a 3-year cash flow projection to show your projected earnings, any other funding that you have, your projected expenses, supplies, and any additional operating costs that you anticipate. They'll also calculate the cash flow available for debt service, projected operating revenue minus operating expenses before depreciation and interest. And they'll also calculate a debt service coverage ratio. This ratio is the ratio of your cash flow available for debt service divided by your projected annual debt payments or your principal and interest. Lenders will also want to take a look at your collateral. Collateral is something that you can offer in the event that you cannot make your loan payments. Your cash flow is obviously the first source of payment for a loan. Your collateral would be the second source of repayment. If your cash flow is not sufficient to cover debt payments for an extended period, for example, lenders may look to use your collateral to cover the repayment. Above all, if you're embarking on a project that is likely to require some form of loan financing, we recommend that you engage with lenders at an early stage. Walaleo and thank you everyone. If you enjoyed this video, make sure to hit that subscribe button and follow us on all of our social media accounts. You can contact us at any time by visiting our website www.ulnueg.ca.